I made $1 billion in a single day, September 16, 1992, Black Wednesday, the day I broke the Bank of England. My name is George Soros, and I'm going to tell you exactly how I did it, not because I want to boast, but because the principles behind that trade reveal something fundamental about markets, risk, and human nature itself. People call me the man who broke the pound, but the truth is, I didn't break anything. I simply saw what was already broken, and I had the conviction to act on it. Today, I'll walk you through every step of that trade, how I identified the opportunity, how I built the position, and why I risked everything on a single idea. But more importantly, I'll share the lessons that transformed me from a successful investor into someone who understood markets at a deeper level. Because here's what most people don't realize, that billion-dollar profit wasn't about luck. It was about recognizing an inevitable outcome that everyone else refused to see. To understand how I made that trade, you need to understand where I came from. I was born in Budapest in 1930. I survived Nazi occupation as a teenager, then escaped communist Hungary in 1947. I arrived in London with nothing, worked as a railway porter and a nightclub waiter while studying at the London School of Economics. Those experiences taught me something crucial. Reality doesn't care about official narratives. What matters is seeing things as they actually are. By 1992, I'd been managing the Quantum Fund for over 2 decades. We'd built a reputation for large, concentrated bets based on macroeconomic analysis. But I'd never made a trade of the magnitude I was about to attempt. For those unfamiliar with currency trading, let me explain the basics. Countries sometimes try to fix their currency values within certain ranges, what's called a peg or managed exchange rate. They do this by using their central bank reserves to buy or sell currency, keeping it within predetermined boundaries. The British pound in 1992 was part of the European exchange rate mechanism, the ERM. Britain had committed to keeping the pound within a specific range against the German Deutschmark. The government promised they would do whatever it takes to maintain that peg. That promise was about to be tested, and I was going to be the one testing it. The setup for my trade began years before Black Wednesday. Britain joined the ERM in October 1990 at what I believed was an overvalued rate, 2.95 Deutschmarks to the pound. Why did they choose such a high rate? Political pride. The British government wanted to show strength, but economics doesn't respect political pride. Here's what I observed. Germany had just reunified, and the Bundesbank was raising interest rates to control inflation in the former East Germany. High German interest rates meant a strong Deutschmark. Meanwhile, Britain was entering a recession. They needed lower interest rates to stimulate their economy, not higher rates to defend an overvalued currency peg. This was the fundamental contradiction. Britain needed monetary policy that served its domestic economy, but the ERM forced them to follow German policy instead. For months, I watched British politicians make increasingly desperate statements. We will defend the pound. Leaving the ERM is not an option. The more emphatic their promises became, the more I understood they were trying to convince themselves, not the markets. I've learned that when governments try to defend the indefensible, with words alone, they're usually preparing for surrender. What I saw next confirmed everything. By the summer of 1992, my team and I were conducting detailed analysis. We looked at Britain's foreign exchange reserves, the war chest they'd used to defend the pound. We estimated they had about $44 billion available. That sounds like a lot, but currency markets are enormous. Daily trading volume in pounds was hundreds of billions. We examined the political situation. Chancellor Norman Lamont was making brave statements, but Prime Minister John Major's government was divided. Some officials quietly believed the pound was overvalued. This internal conflict mattered because defending a currency requires unity and resolve. We studied historical precedents. Again and again we found the same pattern. When a currency peg contradicted underlying economic fundamentals, the peg eventually broke. It wasn't a question of if, but when. The technical analysis supported our thesis. The pound kept hitting the bottom of its SERM band, requiring repeated Bank of England interventions. Each intervention depleted their reserves a little more. They were trying to hold back the ocean with a bucket. But here's the crucial insight that separated me from other investors who saw the same data. I understood that this wasn't just an economic problem, it was a reflexive system reaching its breaking point. I've spent my career studying reflexivity, the idea that market participants' perceptions can change the fundamentals they're supposedly just observing. In this case, the more the pound weakened, the more speculators would attack it. The more speculators attacked, the more reserves Britain would burn through. The more reserves they lost, the less credible their defense became, and the less credible their defense became, the more speculators would attack. It was a self-reinforcing cycle with only one possible outcome. By late August 1992, I had complete conviction. The pound would break. The only question was, how large a position should I take? And that's when I made a decision that stunned even my closest colleagues. I decided to risk it all. In early September, I instructed my team to begin building a massive short position against the pound. We borrowed billions of pounds, immediately converted them to Deutschmarks and dollars, and waited for the pound to collapse, so we could repay our loans with cheaper currency. My team was nervous. Stanley Druckenmiller, my lead portfolio manager, thought we should short $1.5 billion worth of pounds, a huge position by any standard. I looked at the analysis. I looked at the certainty of the outcome, and I told him, go bigger. This is the trade of a lifetime. We increased the position to $10 billion, nearly 150% of the entire quantum fund's capital. If I was wrong, we'd be wiped out. People often ask me, weren't you terrified? How could you risk everything on a single trade? But you see, that's where most people misunderstand risk. They think taking a large position is automatically risky. But risk isn't about position size, it's about the probability of being wrong multiplied by the magnitude of the potential loss. When I looked at that trade, I saw overwhelming probability of success. The British government was fighting against fundamental economic reality. They had limited ammunition. We had infinite patience and deep pockets. The risk-reward ratio was extraordinarily favorable. The real risk would have been betting too small. By mid-September, other hedge funds and banks were joining us. The speculation against the pound was building into an avalanche. On September 15th, I gave an interview to a German newspaper essentially stating that the pound should be devalued. I wanted to accelerate the crisis. Some people criticize this as manipulation, but I wasn't manipulating anything. I was simply stating what the data already showed. The pound was overvalued. Everyone who looked honestly at the numbers knew it. The British government spent that evening in emergency meetings. They raised interest rates from 10% to 12%, then announced they'd go to 15% the next day. They were trying to make holding pounds so attractive that speculators would back off. It didn't work. What happened next changed financial history forever. September 16th, 1992, Black Wednesday. The British government threw everything they had at defending the pound. They spent billions from their reserves buying pounds. They raised interest rates to punishing levels. Norman Lamont went on television promising they would never surrender. But by 2:00 p.m., it was over. The Bank of England had burned through a substantial portion of Britain's reserves. Estimates suggest they lost around $3.3 billion in a single day. The political will collapsed. The mathematical reality became unavoidable. At 7:00 p.m., Lamont emerged from 11 Downing Street and announced that Britain was suspending its membership in the ERM. The pound would float freely. In practical terms, this meant the pound immediately devalued by about 15%. Over the following weeks, it fell further. For me and the Quantum Fund, this meant we'd made approximately $1 billion in profit. Some estimates put it as high as $1.1 billion. We'd borrowed pounds at one rate, and now we were repaying those loans with much cheaper pounds, pocketing the difference, $1 billion, in a single day. But here's what matters more than the money. I was right about the analysis. The conviction I'd built through months of research had been validated completely. The press called me the man who broke the Bank of England. Some British politicians called me worse names, but I didn't break anything. The system was already broken. I just had the courage and the capital to bet on that reality. This is what I learned. Large profits in markets aren't made by being slightly smarter than everyone else. They're made by seeing a fundamental dislocation between reality and perception, having the conviction to act on that insight, and sizing the position appropriately. Most investors see opportunities but bet too small. They're afraid of being wrong, but in investing, being half right with a small position makes you very little money. Being completely right with an enormous position makes you a fortune. Now you might wonder, did I feel guilty about the chaos this caused? After Black Wednesday, Britain entered a period some called White Wednesday instead. Freed from the constraints of the ERM, the Bank of England could cut interest rates and stimulate the economy. Britain's recession ended. Economic growth returned. Some economists now argue that Britain leaving the ERM was the best thing that could have happened to their economy. They just needed a push to accept reality. Did I cause harm? I don't believe so. I accelerated an inevitable adjustment. If not me, someone else would have broken the peg eventually, and the longer Britain defended the indefensible, the more reserves they would have wasted. Markets are amoral. They don't care about political promises or national pride. They reflect underlying economic realities. My role was simply to help prices find their true level. But I understand why some people were angry. Working-class Britons saw their politicians humiliated. Some lost their homes when interest rates spiked during the crisis. That pain was real. Yet I'd argue the pain was caused by the government maintaining an overvalued currency for too long, not by speculators who finally forced the adjustment. This raises a profound question about markets and society that I've spent decades wrestling with. So what can you learn from the trade that made me a billionaire? First, reality always wins eventually. Governments, corporations, and individuals can deny reality for a while, sometimes for years. But fundamental economic forces are like gravity. You can't repeal them with speeches or willpower. The British pound trade worked because I aligned myself with reality rather than political narratives. Second, conviction requires preparation. I didn't wake up one morning with a hunch about the pound. I spent months analyzing data, building models, studying history, and pressure testing my thesis. When the moment came, I had absolute conviction, not because I was gambling, but because I'd done the work. Third, size your bets to match your conviction. When you've found a trade with overwhelming probability of success and asymmetric risk-reward, bet accordingly. Most people make the mistake of betting the same amount on every idea. They bet as much on their mediocre ideas as their best ones. This is insane. When you find the trade of a lifetime, treat it that way. Fourth, markets are reflexive systems. Perception shapes reality, which shapes perception. Understanding these feedback loops gives you an edge because most participants don't think this way. They assume markets simply discover pre-existing values, but markets create values through the interaction of participants. Fifth, timing is crucial, but you can create timing. I didn't just wait passively for the pound to collapse. I gave that interview. I built a position large enough to influence the market. Sometimes the difference between a good trade and a great one is having the courage to be a catalyst. What would you do in my situation? If you'd conducted the same analysis and reached the same conclusions, would you have had the courage to risk everything? Or would you have played it safe with a smaller position and made far less? These aren't just abstract questions about finance. They're questions about how you approach opportunity, risk, and conviction in every area of life. The Black Wednesday trade defined my career, but it also taught me something that extends far beyond making money. It taught me that the greatest opportunities come when you're willing to stand against consensus, when you can see reality more clearly than others, and when you have the courage to act on your convictions. I want to hear your thoughts on this. What aspects of this trade intrigue you most? Do you think what I did was ethical? Have you ever had a moment where you saw an opportunity that others missed? And if so, did you act on it? Comment below with your perspective. And if you found value in understanding how this trade actually worked, the analysis, the conviction, the execution, there's much more to explore about market psychology, reflexivity, and macroeconomic investing. Until next time, trust your analysis, size your bets appropriately, and remember that reality always wins.